So have you ever looked at a stock with a massive, eye-watering 61 times price-to-earnings ratio and just thought to yourself, yeah, there's absolutely no way a disciplined value investor would ever touch this? Well, honestly, prepare to have your assumptions totally challenged today. Welcome to this full analysis explainer on Constellation Software. People often call this company the Berkshire Hathaway of software, and for good reason. It is an absolute powerhouse of a compounder that's just quietly built this massive empire. Today, we're going to break down exactly how they do it, why that sky-high PE ratio is actually kind of a mirage, and figure out what the stock is fundamentally worth right now.
Okay, let's dive into this. We've got a really clear structure for our explainer today. First up, we're looking at their permanent capital machine. Then, unpacking that insanely wide moat. After that, we'll do a reality check on their financials, looking at free cash flow versus GAAP. Then we'll cover the structural risks and wrap it all up with a definitive valuation and final verdict. Let's get right into it.
All right, Section 1, the permanent capital machine. Let's decode this business model.
To truly get how this machine operates, you have to go back to 1995 when Mark Leonard, who is literally a legendary capital allocator, founded the company. Fast forward to today, and they hold over 1,000 different businesses across more than 100 industry verticals with something like 64,000 employees. But, what do they actually do? Well, they target vertical market software, or VMS. This isn't your broad, everyday software like Microsoft Word or Excel. No, VMS companies build highly specific, super niche software. We are talking about things like scheduling systems for healthcare clinics, or billing software for regional water utilities, or management platforms for public transit. These are deeply embedded, absolute mission-critical workflows. Think about it. Once a mid-sized water utility installs this billing software, they are highly, highly unlikely to ever switch. The sheer headache of retraining staff, migrating all that data, and dealing with compliance updates, it's just too painful. And that is exactly the kind of incredibly sticky business Constellation targets.
And when they find those sticky businesses, they execute this unyielding four-step playbook. Step 1, they acquire these niche players at really reasonable multiples. Historically, we're talking around 1 to 3 times revenue. Step 2, they enforce minimal central management. Basically, they just let the acquired companies operate totally autonomously. Step 3, they extract the free cash flow generated by those rock-solid customer contracts. And Step 4, they take that cash and immediately redeploy it into even more acquisitions. But here is the absolute golden rule of Constellation Software. They never sell. They essentially provide a permanent home for these businesses, which just lets their capital compound indefinitely. Moving on to Section 2, unpacking the wide moat and why nobody can just copy this model.
Now you might be wondering, okay, if the playbook is just 4 simple steps, why isn't everybody doing this? Well, competitors like Roper Technologies certainly try, but they operate at just a fraction of Constellation's deal volume. Constellation stays way ahead because of 4 incredibly deep layers to their competitive moat. First, like we just talked about, are the switching costs. Because this software is so mission-critical, Constellation has enormous pricing power. They can regularly bump up maintenance fees above inflation, and they see almost zero customer churn. Second is their massive scale and capital deployment. They literally have hundreds of analysts whose only job is to source and evaluate deals. Replicating that kind of infrastructure would take a competitor at least a decade. Third is that decentralized, highly entrepreneurial culture we mentioned. And fourth, their promise of permanent ownership. This is a huge deal for owner-operators. If you've spent your life building a niche software company, you want to sell it to someone who won't just fire your staff and destroy your culture like a typical private equity firm might. Constellation's forever home pitch is incredibly appealing.
Which brings us to Section 3, the financials. Let's do a reality check on free cash flow versus GAAP. Now, what's really interesting about this slide is that if you just pull up standard financial screeners, you're going to get a completely distorted view of this company. Their GAAP net income, which was around $767 million for fiscal year 2024, looks shockingly low for a company of this massive size. That low number is exactly what creates that crazy 61 times PE ratio we mentioned at the very beginning. But here is the insider secret. That GAAP number is severely suppressed by non-cash acquisition amortization charges. Basically, every time they buy a company, the accounting rules force them to amortize the intangibles. On paper, it looks like this massive, glaring expense, but in reality, it doesn't actually cost them a dime in cash. The true measure of their economic earnings and the real engine of their compounding power is free cash flow. And when you look at their trailing 12-month free cash flow, wow, the number is absolutely staggering, $2.66 billion US. And that cash flow has been growing at roughly 29% over the last 3 years. Their free cash flow margin sits at about 23% of revenue. Plus, because their capital expenditure is just incredibly minimal, we're talking only about $68 million recently. Almost all of that operating cash flow translates directly into pure owner earnings. It's just sitting there, ready to be fired right back into the acquisition engine. And all that tremendous cash generation creates a fortress of a balance sheet. Now, on paper, Constellation carries about $5 billion in total debt. Sounds like a lot, right? But when you factor in their $2.77 billion in actual cash, their net debt drops down to $2.23 billion. Notice something amazing here? Their trailing 12-month free cash flow actually exceeds their total net debt. That means, theoretically, this company could wipe out every cent of its net debt in less than a single year. For a company that relies heavily on rolling up acquisitions, that level of financial security is just phenomenal.
All right, let's pivot to Section 4, risks to the compounder. What could actually go wrong here?
Let's be real, no investment is totally bulletproof, and we need to keep our assessment totally neutral. Here are the main triggers for the bear case. First up is the shrinkage of their acquisition pipeline. Because they're getting so massive, they need to buy larger and larger businesses to move the needle. And the problem is, larger targets usually demand higher purchase multiples, which could squeeze their historically amazing returns on invested capital. Second, we have to talk about management succession. Mark Leonard has been slowly stepping back from his executive role. And while the culture seems really deeply ingrained, losing a truly world-class capital allocator is definitely a risk. Third is artificial intelligence. Yes, VMS software is deeply entrenched, but there is a long-term, slow-moving risk that AI platforms could eventually serve these exact vertical niches at a fraction of the cost. And finally, organic growth. If you strip away the acquisitions, Constellation's organic growth is hovering near zero, typically just 2 to 5%. They are entirely dependent on that continuous M&A engine to keep the whole thing running.
Okay, Section 5, the valuation and our final verdict. Let's bring it all together.
So, knowing about this incredible moat, but also keeping those structural risks in mind, what is this stock actually worth today? Well, the current stock price is sitting right around 2,950 Canadian dollars. If we run a really conservative discounted cash flow model using a 10% discount rate, we get an intrinsic value of roughly 3,260 CAD. That suggests the stock is currently about 25% overvalued. But wait, if we flip it and use a market earnings value based on a fairly conservative 28 times multiple of their massive free cash flow, the value jumps all the way to 4,745 CAD, meaning it looks 61% undervalued. So the crucial point is, if we take a blended average of these two methods, a really reasonable fair value sits at approximately 3,540 CAD. That implies the stock is actually modestly undervalued by about 20% right now. But to really wrap our heads around the risk-reward here, we have to model a few different futures. In our bear scenario, say deal multiples spike and that ROIC really starts to degrade, the value crashes down to around 1,600 CAD. In our base scenario, where we assume a steady 15% free cash flow growth over the next 5 years, we hit that fair value of roughly 3,400 CAD. But check out the bull scenario. If their execution stays flawless and they successfully deploy massive capital globally, the value skyrockets to an unbelievable 6,500 CAD. So there is absolutely massive upside potential here, but, for sure, substantial downside if the compounding machine starts to stutter.
So, what's the actionable takeaway? Here is our verdict. Constellation Software is a hold, or maybe a very cautious buy at current levels. At 2,950 CAD, your implied annual return over the next 16 years is a solid, though maybe not totally spectacular, 8.1%. If you are a highly disciplined investor looking for a definitive margin of safety, and you want that target 9% annual return, you're going to want to be patient. Wait for a broader market pullback. Your target entry price to lock in those premium returns is right around that 2,420 CAD mark.
And this brilliantly illustrates one of the greatest frameworks in all of investing. If the late, great Charlie Munger were looking at Constellation Software today, he wouldn't be losing sleep trying to find it at some deep, deep discount. He would classify it exactly like this: an exceptional business at a fair price. That switching cost mode, their radical, borderline obsessive devotion to returns on invested capital, and that whole permanent ownership ethos, it makes this an incredibly rare asset in the public markets.
You know, while the rest of the market is out there frantically chasing the next massive, totally unproven AI fad, Constellation is just quietly proving that boring niche software might actually be the greatest wealth-building engine of our generation. And that wraps up our deep dive explainer for today. But before you go, I really want to hear from you. We build these full analysis explainers based specifically on what you guys need to understand. So take a look at your own portfolios. Which stock is confusing you right now? Which company's moat do you desperately want us to unpack next? Comment down below with the specific stock you want me to cover in our next explainer. Keep learning, keep compounding, and I'll see you